So it's another perfect afternoon. We meet again for this live session. So it has been time since we did our last live session during the last semester. That is the semester which ended August. So now we have commenced other live sessions from this September until the end of November. So beside the live sessions which will be done, also there will be live classes through the Zoom platform. So welcome all as we start the journey towards the preparations of the December exams. So I will be doing live sessions, of which I will be starting with sitting past papers. And to be more specific, I always look at most CFR and advanced financial reporting. So of which on today's session, I will be able to look at advanced financial reporting. So on this advanced financial reporting, I would like to look at the consolidation question. That is question 2. The consolidation question, that is question 2 for the advanced financial reporting. So we have advanced financial reporting. So this is, I will be looking at the August 2024 past paper. To be more specific, question 2. So that question 2 is on the area of consolidation, the group accounting. So it's on the area of a consolidation, that is group accounting. And this question was whereby you find that there was a joint venture which was acquired initially and a subsidiary. But now, with time, under the joint venture, they went ahead to add 30% control. So meaning that this is a piecemeal, or we call it step-up acquisition under consolidation, whereby you find that initially, even if there was one company acquiring, like now there is A acquiring B and C. So initially, at some point, it acquired what? It acquired 50%, and this one was, I think, it was 70. Or I can just give an example. So there's A acquiring B and acquiring C. At some time, it acquired B up to 50%. But going ahead, it added 30% here. So meaning that if our financial year was running from January to December, and you find that by January, 50% was acquired, but by September, coming September, they added 30% here. So meaning that from this point to this point, we have a 50%. So B was a joint venture at 50%. But from September to December is at 80%. So meaning at this point, there is something we call the recognition of the initial percentage. The recognition of the initial percentage of 50. So we need to check gain or loss on this recognition. Gain or loss on the recognition of the 50%. So this is what we call step up. Step up what? Step up acquisition of subsidiaries, or just step up acquisition of the investee companies. Step up acquisition of investee companies. So to be more specific, I can go direct to that question. Let me go direct to that question. So that is August 2024 past paper. Question number 2. Question number 2. It was saying, Pata Limited, a quoted company which operates in the agricultural sector, has investments in number of companies. So the following financial information relates to Pata Limited and its investment companies. So you have been provided with a statement of profit or loss, and you are given an extract of equity. Then let's go through the additional information one by one. So I will be going through the additional information one by one. So additional information number 1, they were saying that On 1st July 2021, Pata Limited acquired 75% of the ordinary shares of Soma Limited for a cash consideration of 4,500. So there's a subsidiary which has been acquired. So I can go ahead and write something here. So there's this company called Pata Limited, which had acquired another entity called Soma. According to Note 1, Soma Limited had been acquired up to 75%, of which you are told the cash consideration is 4,500, when the retained earnings of Soma Limited stood at 2,100. At the date of acquisition, the fair value of identifiable assets approximated their carrying value, with the exemption of an item of plant, had a fair value exceeding its carrying amount by 600. The plant had a remaining economic useful life of 6 years at acquisition. So when you are told that there is an asset which is called plant that had a fair value, it had a fair value exceeding what? Exceeding fair value exceeding carrying amount by 600. So the fair value was in excess of the carrying amount by 600. So means that this 600 is what we call fair value uplift. Fair value uplift, or at some scenario they call it revaluation gain. Revaluation gain. So there is an increase in this plant. There's an increase in plants, and this will affect our. Remember, this one is classified as a property, plant, and equipment item. So this revaluation gain will affect that account, the property, plant, and equipment account. So with the revaluation gain, you need to know what you are supposed to do. So with the revaluation gain, you need to debit what? PPA account, debit your property, plant, and equipment account, credit revaluation reserve account. Revaluation reserve account. You do that. So debit the property, plant, and equipment account, credit the revaluation reserve account. So meaning that the asset has increased in value. There is a revaluation gain. Then they went ahead to say that the plant had a remaining useful life of 6 years. There is remaining useful life of 6 years. So you see, this value, the asset has revalued with the 600 has not been subjected to depreciation. The 600 has not yet been subjected to depreciation. That is why you are being provided with the remaining useful life, so that you determine what we call depreciation undercharge. You compute what we call depreciation undercharge. So this one, you take 600 divide by 6, you get your 100. That is depreciation undercharge. With the depreciation undercharge, what are you supposed to do? Remember that a depreciation is an expense. If you understated your expense, it means that the profit is in excess. So we need to correct that by debiting retained earnings account. Retained earnings what? Account. And at the same time, if you did a depreciation undercharge, and you know that a fixed asset is the one which is depreciated, and now you have done a depreciation undercharge, it means that the value of the asset is more. The value of your fixed asset is more. So we need to adjust. Our property, plant, and equipment account must be credited. So you credit the property, plant, and equipment account. So that one concerns additional information number 1. So let's move to additional information number 2. On 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish joint control over net assets and operations of Jana Limited. So it went ahead to acquire another joint venture at 50%. Pata Limited acquired 50% of the ordinary shares of Jana Limited for a cash consideration of 700 million, when the retained earnings of Jana Limited amounted to 1,300. Pata Limited equity accounted for its share of interest in Jana Limited in line with International Accounting Standards 28, investment in associates and joint ventures. We know that when you have joint ventures and associates, you account them using IAS 28, whereby you recognize the associates or joint ventures with the initial cost of investment, add post-acquisition profit, deduct another item which can affect that investment, and mostly that is maybe impairment. So it's all about initial cost of investment, add post-acquisition profit, deduct impairment. That is IAS 28. Number 3, on 1st January 2024, Pata Limited acquired an additional 30% shareholding in China Limited for a cash consideration of 500 million. So here now they are going ahead to add 30%. So I can do this. So our financial year ends on 30th June 2024. It starts on 1st July 2023. Remember, Soma was acquired on 1st July 2021. That one implies that Soma Limited is in the current year, it's a full year what? Full year subsidiary. It's a full year subsidiary. For Jana Limited, remember the 50% was acquired January 2022. But by 1st January 2024, during this year, by January 2024, by 1st January 2024, they added 30% plus 30% here. So remember that from January 2022, sometimes back, from January 2022 up to this period, it was the control was 50. But now from January 2024 going ahead, it will be at 80%, because now we have recognized the 50 by adding 30%. So from January 2024 to June 2024, the control is 80%. So I will come here and say Jana Limited from July to January, those are 6 months. So 6 months joint venture, because now we are considering only this year. Even if yes, the 50% was from 2022, I'm concerned from July to January. So 6 months joint venture. And again, Jana Limited is from January 2024 to June. It's a 6 months what? 6 months subsidiary. 80% is a subsidiary. That is 6 months subsidiary. Very important. We can continue reading. So we were under note 3. They went ahead to say the fair value of the original investments in Jana as at 1st January 2024 was 950. No fair value adjustments were necessary in respect of the identifiable net assets of Jana Limited. Number 4, the group's policy is to measure the non-controlling interest in subsidiary at their proportionate share of net assets as at the date of acquisition. So when we will be computing for our goodwill, we have to consider this note 4. NCI will be based on the share of net assets. Number 5, during the year ended 30th June 2024, Pata Limited sold goods to Soma for 340 million at a fair value of at fair value, at market value, that is. Pata Limited reported a loss of shillings 55 million on this transaction. Soma Limited still had 1/2 of these goods in its inventory as at 30th June 2024. Number 6, impairment review. As at 30th June 2024, revealed that goodwill on acquisition had not suffered any impairment. Number 7, all incomes and expenses of the group companies are deemed to have accrued evenly throughout the year. So the requirement, the first part is not about computing for goodwill. Goodwill computation. The goodwill computation. So we start with the goodwill of Soma. Remember, goodwill is equals to purchase consideration minus what? Share of net assets acquired. Share of net assets acquired. So we can have shillings here in million, and we can have here shillings in million. So we can talk about purchase consideration. Remember, I'm starting with Soma. So the purchase consideration was, remember that as per note 1, when this Soma was acquired, the cash consideration was 4,500. But in note 4, they said the group's policy is to measure the non-controlling interest in subsidiaries at their proportionate share of net assets as at the date of acquisition. So the NCI will be the NCI share of net assets. So you need to add NCI share of net assets, because they have said in note 4 that the group's policy is to measure the non-controlling interest in the subsidiaries at their proportionate share of net assets as at the date of acquisition. So net assets, so let's get the block figure for net assets in Soma. But we have ordinary share capital 500 plus what? Plus the revaluation. So the revaluation was, so we have under Soma we have 500, of which next we have before revaluation I can talk about, remember this is ordinary share capital. I can talk about retained earnings as acquisition date. Retained earnings must be as acquisition date, which is provided at 2100 under additional information number 1. Then now finally we can talk about the revaluation. Also the revaluation as at the date of acquisition. So the revaluation is 600. The one they talked about in note 1, that the fair value was in excess of the carrying amount by 600. They mentioned that one in note 1, that as at the date of acquisition, the fair value. Before I mention about the revaluation, let me talk about retained earnings. In note 1, they say there's somewhere they mentioned that when the retained earnings of Soma Limited stood at 2100, then they went ahead to say that at the date of acquisition, the fair value of the identifiable net assets approximated their carrying values with exemptions of an item or plant. So I think I've already explained about that. So that is revaluation as at the date of acquisition, as at the date when Soma was acquired and being a subsidiary. So as at the date of acquisition, This is direct from the extract of equity. So 500 plus 21 plus 600, that is those are the values that will provide us with the total retained earnings. So as I pick my calculator, here, I think also you can, for the guys following, you can give me the answers through the chat. There's an option for chatting. Because I can see that now Evan Soyugi is saying that I can't miss your class, sir. You helped me. pass FR. Congratulations, Evans. Huh? Congratulations. So welcome to Advanced Financial Reporting. Welcome to Advanced Financial Reporting. So these net assets totals to 3,200. So, and you know that the percentage for summer was 75%. So the NCI will be 25%. So 25% of the net assets. 25% of the net assets. So 25% of 3,200, that is 800. Eh? That is 800. So 45 plus 800, so that is 53. That is 5,300. Then now you deduct what? Fair value of net assets. Fair value of net assets at acquisition. At acquisition. So the fair value of net assets at acquisition are just these ones. So the ordinary share capital, retained earnings, and revaluation reserve. So we can just list them. Let me clear this board. So ordinary share capital. So ordinary share capital we have seen is 500. Retained earnings as acquisition debt from note 1. Retained earnings is 2,100. And the revaluation, which is revaluation gain, we call it fair. That is a fair value uplift. Fair value uplift. That was for plant, note 1. As acquisition debt, 600. So this totals to 32. That is what you deduct there. So 53 minus 3,200. So that is 21. So our goodwill for summer is 2,100. It's not impaired. Then we can do also for what? We can do for this other entity. For this other entity. And you need to understand something here. That initially it was at 50%. Then they went ahead to do what? To add 30. So by that point, that is when we did what? We have an 80% control. 80% control. And then you can only compute this goodwill as at the time that entity is a subsidiary. Meaning that by which time? By January 2024. By January 2024. So the initial percentage is, so we'll talk about the fair value of the previously held interest, fair value of previously held interest. At 50%. When they acquired 50%, they paid. When they acquired 50%, they paid. So according to the question, that is note 2. Pata Limited acquired 50% of the ordinary shares of Jana for cash consideration of 500. That is a cash consideration of 700, not 500. We have 700. That is the fair value of the previously held interest. Fair value of the previously held interest. Then they went ahead to acquire, to add, that is 30, so that by this time we can have Jana being a subsidiary. So the additional, consideration of the additional holding. Consideration of additional holding. So the consideration of the additional holding, when they added the 30, they paid on 1st January 2024, Pata Limited acquired additional 30% of the shareholding in China for a cash consideration of 500. That is 500. Then we said, since they mentioned that in note 4, the group's policy is to measure the non-controlling interest in subsidiaries at their proportionate share of net assets at the acquisition date. So we need to know the value of the net assets in Jana. By the time it was what? It was a subsidiary. Net assets. The net assets. So we have ordinary share capital. So the ordinary share capital, that one is constant. There is no change, which is 300. The next is all about retained profit as at this period, as at January 2024. Retained profit will be, so the retained profit as at this period here will be, remember that this company called Jana was acquired some times back, that is 2022. As at 2022, as at the time of acquisition, the retained earnings was 1,300. The retained earnings was 1,300. The retained earnings was 1,000 what? 1,300. But during the year, so remember that when it was acquired some times back, so meaning that they are opening this year, that is July 2023, with 1,300. But now during the year, during this period, during the year, the profit is, so this one was at acquisition, not as at the opening balance. This one was at acquisition, the 13, because I can see under the equity, under the extract of equity, we are given balance brought forward. So we have a balance brought forward of 1450 under the extract of equity. Then during the year, you are given 500. So meaning that by this time it will be, you just take 1450, which is the balance brought forward plus the first 6 months. But from here to here is 6 months. So we need to apportion this 500 for the year, for the first 6 months. Then we add it to the balance brought forward. So 6/12 times 500. So as at January, it will be 250 plus 250, you add it to 1450. That will be 1,700. That one will be 1,700. It will be 1,700. There's nothing else. So the total equity, the total net assets will be 2,000. That is 2,000. So we say that here we come and add what? Add NCI share of net assets. NCI share of net assets. So remember that the percentage is 20% times what? 20% times 2,000. So 20% of this one is 400. So the total will be, so 700 plus 500, that is 1,200 plus 400. It will be 1,600. Then now we raise what? Fair value of the net assets at acquisition. Raise fair value of net assets at acquisition. Already we have the block figure. I don't have to list one by one. So that is 2,000. So deduct here 2,000. So we have a negative of, so the value would be negative. It will be negative. So remember that here there is something we missed. We said the fair value of the previously held interest. The fair value of the previously held interest. Was it 700 or a different value? The fair value of the previously held interest. So let me do a change under this under that 700, because remember Remember that the 700, so the 700 is the consideration. But now, what we use is the fair value of the original investment. So even if it's not provided, there's a way you compute it. If it's not provided, there's a way we always compute it. That is what I was forgetting. But this one was provided at 950. This one was provided at 950. 950. Then I will mention what if you are not provided with the fair value of the initial investment. The fair value of this 50%. The fair value of the initial investment. The fair value of the initial. It was provided under additional information number 3. The fair value of the original investment in China Limited as at 1st January 2024. 950. It was 950. So we don't have to use the consideration provided direct, but we have to determine it at fair value. At fair value. At fair value. Kindly remember that. Kindly remember that. So this one will be 1850. 1850, you deduct 2000 minus 2000, it will be 150. So 150 is a negative. So that one is not a goodwill, but we call it a per gain purchase. Gain on per gain purchase. When it's a negative, it's not goodwill, but it's a gain on per gain purchase. Gain on per gain what? Purchase. Gain on per gain purchase. Gain on per gain purchase. A gain on per gain purchase. So remember that when you are computing for the goodwill of the investee company which has been initially recognized, you need to determine this consideration, the consideration of the initial investment at fair value. At fair value. You don't have to take the consideration given initially, but you need to determine that consideration at its value currently. So the fair value of the initial investment. So if it's not provided, this is what you do. This is what you do. So if it's not provided, this is how you compute it. If it was not provided, this is how you compute it. So you take the percentage of that initial investment, percentage of initial investment, percentage of initial investment times the ordinary share capital, the number of ordinary shares, number of ordinary shares, number of ordinary shares, the number of ordinary shares times the fair value which will be provided. So you will be given this information. But for this question, the examiner went ahead to provide us with this 950. 950 was provided direct. So this first part of the question was having how many marks? So this one was having how many marks? 6 marks. It was having 6 marks. So I can show you how they marked that one. My good student, I can show you how they did a marking for that. How they provided marks for that. So they did this. So this is a mark. 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 So for this one, it was having 2 marks. So they needed any 2 entries. Any 2 correct entries. Any 2 correct entries, they multiply by 1, you get 2. Any 2 correct out of 1, 2, 3, 4, 5. Any 2. Then for the For this one, for January Limited, it was having 4 marks. It was having 4 marks. So the one which was having 4 marks, they also marked it this way. So remember that these. Then remember under net asset we were having 3 items here. So this one was having 3 marks. 1, 2, 3. Because there was ordinary share capital. There was ordinary share capital. There was retained earnings. So retained earnings was having 2 marks. The computation of retained earnings. Remember there was that ordinary share capital and retained. That's why I'm saying the 2000 is having 3 marks. Because there was this aspect of ordinary share capital, then computation of retained earnings. Because for us to get retained earnings, we took balance brought forward plus the profit given for the year, but 6 months for the profit given for the year. Times the profit. Balance brought forward plus. So this one was balance brought forward plus the 6 months for the profit for the year, so that we were getting that relevant retained earnings or retained profit as at 1st January 2024. So that is why we have a 1, then this one. So that is 3. So for you to get your 4 marks, they needed any 1, 2, 3, 4, 5, 6. So there were 6 entries. Any 4, they needed any 4. Any 4, they multiply by 1, you get your 4 marks. Any 4, they multiply by 1, you get your 4 marks. So we can do the second part of this question. That is the statement of profit or loss. Statement of profit or loss. The statement of profit or loss. Statement of profit or loss. So it was having 14 marks, the second part of the question. So I come here and say part remittent, consolidated statement of a profit or loss. So that is for the year ended. For the year ended 30th June 2024. So that is for the year ended 30th June 2020 what? 2024. It's very easy. So we say shillings there in million. So we start from revenue. So for revenue, remember that you take your parent, the value of the parent, which is 7750, plus subsidiaries. So Soma was a subsidiary for the entire year. So I take 4260. But now for Jana, it was a subsidiary only from this point, from January to June. So those are 6 months. So 6 months of the items of this company there. And now you deduct intergroup sales. So the intergroup sales, that is according to note 5. There was an intergroup sales of 340. You go to the cost of sales. Go to the cost of sales. So cost of sales, we have 5380 plus 2050 plus 6/12 times 1480. Deduct this 340. Add the depreciation under charge, which was 100. I remember it was 100 because it's 600, which is a revaluation gain. The one I call a fair uplift. 600 divided by 6. The remaining useful life was 6. So that here I will be able to get gross profit. After gross profit, I will just go direct to what? Distribution cost. So we have the distribution what? The distribution cost, which is direct. So the distribution cost is all about 495 plus 290 plus 6 over 12 times what? 200. No adjustment. Administrative expenses, I would just mention 760 plus 6, that is 760 plus 650 plus 6 over 12 of the 400 of the 400. Up to that point, I can see we are getting profit from operations. Profit from operations. So we'll be able to get, remember here, something there, something here. After profit from operations, we have finance cost. So the finance cost is 90 plus what? 80 plus 6 over 12 times 60. After the finance cost, before I deduct tax, there's items to be included. Remember that this journal, there's a point it was what? A joint venture. There's a point it was a joint venture from here to here. And that period, the parent must take some share. After that, company has paid tax during this period. So during this period, the profit generated during this period, the parent must take 50% of the profit after tax. So share of profit after tax in joint venture. Share of profit after tax. Share of profit after tax in joint venture. That is, to be more specific, Jana, there is a point it was a joint venture. So the share is 50%. The profit after tax in that Jana was 500. That is profit for the year. But now for the first 6 months. So that is an income to the parent. That is an income to the parent. That is an income to the parent. Then when we were computing the goodwill of this Jana, as at the time it was a subsidiary. Remember, we got a negative. We got a negative goodwill. That negative goodwill, we called it what? Again on bargain purchase. That is an income to the parent. Gain on bargain purchase. You add here. It was 150. Another thing I mentioned that when the recognition occurs, remember that initially it was 50%, they added 30. So they recognized 50. So we need to determine gain or loss on the recognition. Gain struck loss on the recognition of Jana. Gain or loss on the recognition of this. So the gain or loss on the recognition. So what we do, we start with checking on the fair value. We check on the fair value of initial investment. Of initial investment. So the fair value of the initial investment. Remember, as at what period? January 2024. Because that is the time when it was recognized. So the fair value of the initial investment was 950. Remember, initially it was 700, but currently it's at 950. The fair value of the initial investment is 950. 950. Then we compare with the equity accounted values. So compare this with the equity. Compare this one with the equity accounted values. Equity accounted values. Also, as at what period? January 2024. Equity accounted values. Or we can talk about the book value of the investment. So to determine that, the equity accounted values as at January 2024, this is what will be done. So the initial cost of investment in China was so the initial cost of investment, remember it was 700. Initial cost of investment was 700. Add what? The post-acquisition profits. Investors share of post-acquisition. Investors share of post-acquisition profit. Investors share of post-acquisition profit. So how can this be determined? Because it's not directly provided. We know that the balance brought forward is 1450, the profit. For the year is 500. And you know that the 30% was added here. But initially, as at the time they were acquiring these 50%, the retained earnings was 13. Sometimes back, it was 13. That is what they mentioned in that question. That as at the time, this journal was a joint venture. As at the time of acquisition of the joint venture, the retained earnings was 1300. But the balance brought forward is 1450, given under the extract of equity. Then the profit for the year is 500. So how can I be able to determine the investor share post-acquisition profit? How can I do that? So what I will do is very simple. I will do what? I will just do this. So there is this 1450 plus. Remember that I would apportion these 500 to 6 months. So that one, up to this period, we are getting which value? So 1450 plus 250, that is 17. Then the profit which was there as at the time Jana was acquired, being a joint venture, will be deducted. You deduct 13. So this one you deduct because it's included here under the balance brought forward. So after determining that profit, deduct it so that you get the post-acquisition profit. So it's 1450 plus 6/12 times 500 minus the 13, which was there sometimes back as at the time Jana was acquired. So it's the profit as at this date minus the profit as at acquisition date. The profit as at this date minus the profit as at acquisition. Because that profit as at acquisition, it's inclusive here. So we need to remove it. We need to do what? To deduct it. So that one will be 400. Because this is 17. So that one will be 400. So the share, so 50% of 400. 50% of 400, that is 200. So we have a total of 900. The book value of the investment, or we call it equity accounted fair values as of January 2024. So the fair value is 950. The book values of the investment is 900. The book value is 900. The fair value is 950. So the fair value is more than the book values, meaning that there is a gain of 50. There is a gain on the recognition. So you come here and say, we have a gain on the recognition. Gain on the recognition. Gain on the recognition, which is 50. gain on the recognition, which is 50, or we can call it fair value gain on the investment. Fair value gain on the investment. Fair value gain on the investment. The fair value gain on the investment. The fair value gain on the investment. So after that, now I can be able to say that we have a profit before tax, so that we deduct tax. So what I will get here is the profit before tax. So that we deduct income tax. So the income tax, 340 plus 370 plus 6 over 12 times 220. So that we have profit for the year. Let us first get the profit for the year by using our calculator. Our calculator. So this is 13,100. 5380 plus 2050 plus 6 over 12 times 1480 minus 340 plus 100. This is 7930. So 13,100 minus answer. This is 5170. So 495 plus 290 plus 6 over 12 times 200. This is 885. That is distribution cost is 885. So this is 1610. So 5170 minus 885 minus 1610. So that is 2675. 90 plus 80 plus 30. That is 200. Then 50%, that is 250 times 0.5. This is 125. So if we take 2675 minus 200 plus 125 plus 150 plus 50. So this is so this is 2,800 here. 2,800. And now we deduct tax. So tax will be 340 plus 370 plus 6 over 12 times 220. That is 820. Deduct 2,800 minus answer. That is 1980. So we continue. We continue. The question is not yet complete because I can see there is other comprehensive incomes, and also we need to share the profit to the non-controlling interest. So we can continue. So after we have a profit for the year, there is this second, there is a continuation, other comprehensive incomes. So other comprehensive incomes. So under other comprehensive incomes, we have items that will not be be recycled. Items that will not be recycled. So that is gain on property revaluation. Gain on property revaluation. So gain on the property revaluation, we have 265 plus that of a sum, it was 80. 65 plus 80. That is 345. So 345 plus 1980, 1980 plus 345, that is 23, 25. So that is total comprehensive income. That is the total comprehensive income. Then now we need to share this profit for the year and total comprehensive income. So we need to share this to the parent and to the minority shareholders, and at the same time we share this. So profit for the year, so I would say profit for the year. Profit for the year attributable to the owners of the group, that is to the parent. Attributable to the owners of the group. Attributable to the owners of the group. This is the parent company, in short. And also, the one which is attributable to the non-controlling interest. Attributable to the NCI, non-controlling interest. The profit for the year, remember, it was 1980. So I will be able to share the 1980 here to this and this. And also I will come here and say total comprehensive income for the year. Total comprehensive income for the year. Total comprehensive income for the year. The total comprehensive income for the year. Remember this profit for the year. Then we have total comprehensive income for the year. Attributable to the owners of the group. To owners of the group. That is the parent. And attributable to the NCI. Attributable to NCI. So and also I will come and share which value. I will share this 2325. I'm going to share 2325. So I can do a working here. So a working can be done for that. So I will come and mention I will do working only for the non-controlling interest. Non-controlling interest. So that is for Soma and Jana. For Soma and Jana. So profit for the year. Profit for the year. So the profit for the year for Soma, remember that it's 820. And remember, this is the period when we have NCIs when these entities are subsidiaries. Meaning that the profit for the year, for Jana, which is 500, we need to apportion it for the last 6 months when it was a subsidiary. So 500 times 6/12, that is 250. That is 250. So 6/12 times 500. 500, remember, it was profit for the year. It was the profit for the year for Jana. But I'm concerned for the last 6 months. So that is why I'm saying 6/12. Profit for the year was 500. So that is why I have 250. 6/12 times 500. So this profit must be adjusted. Let's adjust this profit. There's only one item to adjust this in this question. The depreciation undercharge. So there was a depreciation undercharge under note 1 based on the favorable uplift of the plant. So depreciation undercharge. So if there was a depreciation undercharge, it means that this profit was more because it was under summer. So I need to deduct that 100. So that my adjusted profit for this one will be 720. There was no adjustment for Jana, so that is 250. That is 250. So that the NCI profit will be NCI profit. The NCI profit. Remember, this one is for the first one we apply 25% of 720, and this one we apply 20% of 250. So 0.25 of 720, that is 180. 180. Then for the other one, 0.2 times 250. This is 50. So this total will be, so if you take 180 plus 50, that is 200 what? 230. That is 230. That is what you take here for the profit for the year. For the NCI is 200 what? 230. So that to get the profit for the parent, so to the NCI is this 230. So that for the owners of the group, you take 1980 minus 230. So the 1980 minus 230. So this one will be 1750. So what about for the profit attributable? That is total comprehensive income for the year attributable to the NCI. Attributable to the NCI. Remember, when we look at other comprehensive income items, we have again on property revaluation. This one is attributable to the parent. For this one, under SOMA is not controlled by the parent 100%. So meaning that under this, there must be something attributable to the NCI. Something attributable to the NCI. So that is why we come here and mention that NCI share on revaluation. NCI share on revaluation, so that we can add it to 180. NCI share on revaluation gain. So the NCI share on revaluation gain on the 80, it will be 25% because it's under SOMA. 25% of 80. So that 0.25 times 80 will be 20. So if I add it to 180, I will have 200. Here it will remain to be 50. So 200 plus 50, that is 200 and what? 250 for this one. So that to the owners of the group, it will be 2325 minus that 250. 2325 minus 250. Here we have 2075. You have 2075. And that is how you are supposed to do this question, students. That is how you are supposed to do this question. Number 2, advanced financial reporting, August sitting. So we already did the first part of the question. This was the second part of the question. It was having 14 marks. I can show you how they were giving you the 14 marks. So this is one entry. This is another one. This is another. This is another one. This is another. This is another one. This is another one. This is another one. They mark this. They don't mark entries. They don't mark entries. Then they would go ahead to mark this 345, 1750 to 30, 2075, and this 250. How many ticks are these? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. But they were in need of only 7. Any 7. They multiply by 2, you get your 14. It's not a must that you score everything. So for any student who scored any correct 7 entries, you are given your 14 marks. They have to multiply by 2. That is how the marking for this was done. So 7 correct. Out of these entries I have done, the mark entries, 7 correct, multiply by 2, you get your 14. So students,